If you're in your 40s, 50s, or even early 60s, you've probably woken up at 3 a.m. asking yourself, do I have enough saved? Will my investments actually support my retirement? Here's the uncomfortable truth. Most people are following outdated strategies that haven't worked since the 1990s. Today, I'm going to show you the real investment approach that leads to a calm, predictable, stress-free retirement. And it's probably simpler than you think. Let me be blunt. Most retirement plans fail for one simple reason. They're built on hope, not strategy. People buy random stocks their neighbor recommended. They follow hot tips from financial media. They panic sell when markets drop and chase returns when markets soar. But here's what almost nobody plans for. Inflation eating away at their savings, skyrocketing healthcare costs, or most importantly, consistent cash flow that lasts 25 to 30 years. And that's where retirement anxiety really comes from. It's not about how much money you have. It's about the uncertainty of whether that money will actually be there when you need it. The good news? There's a better way. What actually works is a plan built around one thing: predictable income. Not chasing the next Tesla, not timing the market, not gambling on crypto or meme stocks, but building a reliable monthly income machine, like a paycheck, that supports your lifestyle whether the market is up, down, or sideways. Let me walk you through exactly how to build it. Step 1. Build a diversified income engine. Step 1 is creating multiple streams of predictable income. Think of it like building a portfolio that pays you every month. Here's what that looks like. First, dividend-paying stocks. Not exciting tech stocks. We're talking blue-chip companies that have paid dividends for 20, 30, even 50 years. Think Johnson & Johnson, Coca-Cola, and Procter & Gamble. Second, bonds and bond funds. These provide steady interest payments and stability when stocks get volatile. Third, REITs, or real estate investment trusts. These let you earn rental income from real estate without being a landlord. And finally, low-cost index funds for long-term diversified growth. Your goal isn't explosive returns. It's steady, repeatable income that shows up like clockwork. That's what turns anxiety into confidence. Step 2. Protect from market downside. Now here's the hard truth. The closer you are to retirement, the less time you have to recover from mistakes. If you're 55 and the market crashes 40%, you can't just wait 10 years for it to recover. You need that money. That's why controlling risk is just as important as growing wealth. Use a smart allocation model. If you're in your 50s, consider a 70-30 split. 70% stocks, 30% bonds. In your 60s, maybe shift to 60-40, or even more conservative. The goal isn't to avoid risk completely. That's impossible. The goal is to avoid unnecessary risk. To sleep well at night knowing a bad month in the market won't derail your entire retirement. All right, here's where most people mess up. They either withdraw too much too fast and run out of money, or they're so scared of running out that they never actually enjoy their retirement. The classic rule is withdraw 3 to 4% per year from your portfolio. If you have $500,000 saved, that's $15,000 to $20,000 annually. Now adjust for inflation every year so your purchasing power doesn't shrink. And here's the key. Your goal is consistent cash flow, not depleting your savings. You want your portfolio to last as long as you do, and ideally, leave something behind. This isn't about restriction. It's about sustainability. It's about never having to worry if you can afford to take that trip or help your grandkids.
Step 4. Keep growing without working. Now, even in retirement, your money should still be working for you. Why? Because inflation never stops. What costs $100 today will cost $130 in 10 years. So before you retire, keep reinvesting dividends and interest automatically. Let compounding do the heavy lifting. And don't make the mistake of sitting entirely in cash. Cash loses value every single year to inflation. Keep a portion of your portfolio growing, even if it's conservatively, so your purchasing power stays strong for decades. Growth is your shield against inflation. Let me bring this back to where we started. Retirement stress doesn't come from the size of your portfolio. It comes from uncertainty, from not knowing if you'll be okay. A retirement strategy built on predictable income, steady, diversified, and protected, removes that fear and replaces it with confidence. You stop wondering if you'll be okay. You know you will be. So if you want me to create a complete, step-by-step retirement portfolio example with real numbers and allocations, just comment the word portfolio below. And make sure you watch my next video, the 5 biggest retirement mistakes to avoid after 40. Your retirement should be calm, simple, and stress-free. Let's make it happen.